Now you're ready to extend your knowledge to a situation where you actually assign costs to products and then trace those costs through the accounting system and finally into the financial statements. We'll be using this example for Fabero Inc. for our illustration. You'll want to have this handout in front of you so that you can work the example with me as we go. The Fabero Inc. example illustrates job order costing. As you can see here, this company manufactures serving platters, and the serving platters are customized, so that makes that type of product perfect for a job order example. Our example will be highly simplified here. You won't see all the detail you normally see, but I hope you'll still get the overall picture of how a job order costing system actually works. Fabero also uses a normal costing system. Remember, in a normal costing system, a company assigns the actual cost of direct labor and direct materials to products, but they assign overhead to their products using a predetermined overhead rate. So they apply overhead to products as they're building them, using some estimate of overhead that they had at the beginning of the year. You can see that estimate here on your document in the last two lines of the leading paragraph. They expect overhead costs for year 2 to be $4,000, and the cost driver that Fabero uses is direct labor hours. They are also estimating direct labor hours for year 2 to be 1,000. So 4,000 divided by 1,000 is how we'll compute the predetermined overhead rate. We'll use that rate to apply overhead to products as they pass through the system. We'll only be doing accounting for the month of January in year 2, just to keep the example small and simple. Most companies use a predetermined overhead rate where they use estimates for a much longer period of time to smooth out fluctuations in the overhead rate. Let's take a look at the worksheet near the bottom of your document that you'll be using to record the transactions. We've got beginning balances here on the first line, so very simple, very small numbers. We have a balanced balance sheet to start with. You'll notice that there's a beginning raw materials inventory of $200 and there's a beginning work in process inventory of $263. Beneath our transaction analysis worksheet, you can see a highly simplified version of some job order cost sheets. Job order cost sheets are used to accumulate all of the different manufacturing costs by job so that at any point in time management knows the total costs associated with each job, and they move those costs from one inventory account to the next and finally into cost of goods sold as the goods themselves move through the manufacturing process. So here we see that there's a job numbered year 1-42, and this is a job that's currently still in process, meaning it's not completed, and that $263 of costs that's in our work in process account up above, it's associated with this job, year 1-42. In our simplified system here, this job was started last year, not completed, and you see we'll have a couple of jobs that are started here in January of year 2. So that's the naming system. This job in work in process was the 42nd job that was worked on during year 1. This balance of $263 associated with job 42, this balance would be, we don't have the detail for it here, but it would be comprised of direct labor costs, direct material costs, and overhead that was applied in the previous accounting period. Overhead applied in the previous accounting period would have been applied using whatever predetermined overhead rate was used in that prior accounting period. So this beginning balance would actually be detailed out into those 3 different categories if we had a true job order cost sheet in front of us. For our purposes, it's enough to know that the total manufacturing costs incurred in prior periods was $263. Well, let's go back up and start recording some transactions. In the first transaction here, the company purchases $800 of raw materials for cash. Record that, then take a look at what I'm doing. Here's our transaction. cash goes down 800, raw materials inventory goes up 800. In transaction number 2, Fabero issues some raw materials into production. So they get the call to move some raw materials out of the raw materials warehouse onto the assembly floor. Some of the materials are requisitioned for job 2, $200 worth, and some of the materials are requisitioned for job 3, $500 worth. So $700 of raw materials come out of the raw materials inventory and go into work in process. It's just another transfer from one asset to another. It would look like this in our worksheet. Raw materials inventory goes down, work in process inventory goes up by the same amount. We know some of these raw materials are being used on job number 2 and some are being used on job number 3. So at this point it's also appropriate to enter those amounts onto the appropriate job cost sheet. So down here on the job cost sheets for job 1 and 2, I've entered the direct materials that's being used on each of those 2 jobs. There were no additional direct materials requisitioned for job number 42. Notice that I've also indicated up here for us the location of this job. All 3 of these jobs are currently in work in process. So the account work in process should currently have $263 plus $200 plus $500 in it, and that'll hold true throughout this process. At any point in time, all manufacturing costs should be assigned to some job that's in the system. Okay, the next entry here is for direct labor costs. Fabero has total direct labor costs of $16.20. They haven't been paid yet, so we'll use a wages payable account. So that's easy enough to record in the general ledger or in our accounting worksheet in our simplified version. In addition, though, for manufacturing, we also have to be able to assign those labor costs again to the jobs. So here we have the information to do that. 5 hours can be traced to job number 42, 25 hours to job 1, and 51 hours to job 2. With those hours and with the $20 per hour hourly rate, we can compute the dollar cost of direct labor that's being assigned to each of these 3 jobs. It needs to total up to $16.20. So let's record the transaction in our equation worksheet, and then we'll complete the job order cost sheets. As you know, all of our manufacturing costs go into this work in process account. So we had a beginning balance in this account, we added the cost of direct materials, now we're adding the cost of direct labor. The other side of the $16.20 is an increase to wages payable, the liability account. Let's drop down to the job order cost sheets. In here you can see I've put 5 direct labor hours times $20 an hour into job 42, 25 hours times $20 an hour into job 1, and 51 hours times $20 an hour into job 2. And I also completed my total column over here just to make sure that those indeed did add up to the $700 for materials and the $16.20 for labor, and they do. Alright, well let's take a look at this next entry. In entry 4, Fabero incurs $310 of actual overhead costs, and here to keep it simple, they're just paying for all these overhead costs in cash. So here's the components: lease, utilities, indirect labor, and indirect materials. Those should add up to $310. Because Fabero is using a normal costing system, applied overhead is what increases the work in process account. When they incur actual overhead costs, the other side of the cash entry, in this case, is the manufacturing overhead control account. Let's give it a shot on the worksheet. Here's the entry. We decrease cash by $310, and instead of increasing the work in process account like we would if this was an actual costing system, because it's a normal costing system, instead the other side of the entry to account for our actual cost of overhead is in this manufacturing overhead control account. So to balance, it's going to be a negative balance. Now I happen to be showing the manufacturing overhead control account over here as an equity account. I could actually stick it anywhere in the accounting equation. It doesn't really matter because at the end of any accounting period, this account is going to have a zero balance. It will get closed out. We don't need to do anything with the job cost sheets because this $310 is not being added to the cost of our jobs. Instead, we will apply overhead to our jobs using the predetermined overhead rate. And we do that here in transaction number 5. So transaction number 5 says apply overhead. Use the predetermined overhead rate. Well, do you remember how we said we were going to calculate that predetermined overhead rate? It's always your estimated overhead, usually for a year, divided by your estimated cost driver for that year. Our cost driver is direct labor hours. So we're going to divide $4,000 of estimated overhead from up here by 1,000 estimated direct labor hours. And as I think we said earlier, our predetermined overhead rate turns out to be $4 an hour. Now to apply overhead, you take your predetermined overhead rate times your actual level of activity. Well, our actual number of direct labor hours is up here. We worked 81 hours in January. So the amount of overhead that we apply to jobs and add to the work in process account is 4 times 81. Applied overhead will be $324. Let's do that transaction, and we have to add $324 to the job cost sheets. Work in process goes up by applied overhead. In a normal costing system, you add the actual cost of materials, the actual cost of labor, and the applied amount of overhead. Because we're not paying for this $324, it's just a computation, the other side of this entry also goes to that manufacturing overhead control account. At this point, the difference between these two numbers is our overhead variance. Let's see how the cost sheets look. How would we apply overhead? Well, we apply overhead based on how many direct labor hours were used on each job. So $4, our predetermined overhead rate, times 5 is the amount of overhead that gets assigned to job number 42, and so on. You should be able to verify these balances for yourself in job 2 and job 1. And then I've also totaled everything again over here, and I've got a grand total cost for all of these jobs. Now we'll start to see some movement. So first of all, in transaction number 6, it says during January, remember we're doing accounting for January, Fabero completed jobs 42, that one was started last year, and job number 1. Since those are completed, we move the costs for job 42 and job 01 out of work in process and into finished goods. So this is where we need the job cost sheets. What is the total cost of job 42 and job 1, the jobs that were complete? Well, we have a record here. It's $383 plus $800, or $1,183. $1,183 comes out of work in process and moves into finished goods. $1,183 is cost of goods manufactured. It's the cost of all the goods completed during the accounting period. We completed jobs 42 and job 1. Let's see what's next. Now we sell a job. We sell job 42 for $600. So we know our sales revenue is $600, and we know our cost of goods sold because we can look up the cost of job number 42. So we're back down here looking at these cost sheets. I forgot to do something a moment ago. Both job 42 and job 1 should have been moved to finished goods. After we recorded that last entry, these two jobs were in finished goods and only job 2 was in work in process. So the balance in work in process after our last entry should have just been $1,724. And if we did the math up here, that is what it would be. Now what was happening is we're selling job 42. So we need to take the cost of job 42 out of finished goods because it's now been sold that cost will move to cost of goods sold, the expense account on the income statement. So let's move 383 out of finished goods into cost of goods sold. I recorded two transactions here. This first one was just moving the cost of job 42 out of finished goods inventory into cost of goods sold. So decrease assets, decrease on the equity side. This is our expense. Notice that I've called this normal cost of goods sold. So this is cost of goods sold with applied overhead attached to those jobs. We will have to adjust this to account for that overhead variance before we complete our financial statements. Second entry here was just for the sales revenue. We sold this job for $600. So let's total up our balances here and see what we have at this point. At this point, we still have $300 in our raw materials inventory. Work in process inventory has $1,724 in it. Finished goods inventory has $800 in it. What does the balance in these accounts tie to? Well, all these costs need to be on a job order cost sheet. So what job is in work in process inventory? Job 2 is still in work in process, and you can see that it does have $1,724. Job 1 is the job that's in finished goods, and finished goods has $800 in it. Any point in time, we can trace our jobs into work in process, finished goods, or cost of goods sold. So what's left to do here? Just this last transaction. Our last transaction is to close out that overhead variance to cost of goods sold. If an overhead variance is immaterial, we just adjust cost of goods sold directly for our over application or under application of overhead. If the overhead variance was material, we would instead allocate it among the work in process, finished goods, and cost of goods sold account. You won't be asked to do that type of allocation. So here's what we do. We want this manufacturing overhead control account to be 0. Since we have a positive equity balance, because I happen to list it over here under equity, we're going to reduce this account by $14, which means we need an increase in equity of $14. This $14 positive equity amount is a reduction to cost of goods sold. We applied overhead of $324. Our actual overhead was only $310, so we applied too much expense to our inventory. We applied too much overhead. So we have too high of a cost of goods sold. This $14 therefore reduces cost of goods sold. If you've over applied your overhead, the adjusting entry reduces cost of goods sold. If you've under applied your overhead, the adjusting entry increases cost of goods sold. Our $383 of cost of goods sold, normal cost of goods sold, minus this $14 adjustment gives us an adjusted cost of goods sold of $369. This $369 is the expense that will actually show up in our financial statements. If you check, you'll see that at the end of all this, our total assets are still equal to our total liabilities and total equity. Let's take a quick look at the financial statements to close out this example. You've already seen similar financial statements for an actual costing system, so you can print these out. I just want to point out the difference here with a normal costing system. So almost everything looks the same, and you can see once again you've got the flow of inventory method, and on the other side the more formal method. This is the inventory flow method I'm looking at. So for work in process, one of the things I want you to notice is this work in process flow shows manufacturing overhead applied as opposed to actual cost of manufacturing overhead, and you're seeing the $324 there. When you get down to finished goods, you'll see that the first thing that you come up with here, because we're tracing the cost through the finished goods account, is that normal cost of goods sold is $383. And you just saw that a few moments ago on our worksheet. Then you would actually see the adjustment for the overhead variance of $14, and bottom line cost of goods sold that would then go to the income statement is that adjusted cost of goods sold number of $369. So the theory is all the same. The only difference is because we used applied overhead in the work in process account, we need to adjust our cost of goods sold at the end here in our cost of goods sold computation.